What's up, YouTube? It's RPU here, and I'm back again with another video. And guys, the banks are in crisis. Jerome Powell is raising interest rates. Liquidity is drying up, and it's got me a little worried about Capital One. I'll explain why in this video. I'll try to make it brief. So this is from CBS News. A couple of weeks ago, 10 banks from Moody's were downgraded. Moody's downgraded the credit ratings of 10 small to mid-sized banks, citing growing financial risks and strains that could erode their profitability. The credit ratings agency also warned it is watching some of the nation's biggest lenders for potential downgrades. In its report, Moody's highlighted that some of the issues that caused the banking crisis earlier this year haven't disappeared. Banks are still at risk for depositors to withdraw their funds, while the current higher interest rate environment is knocking down the value of investments lenders made when rates were super low. Yeah, so a lot of these banks bought bonds at 0% interest rates, and interest rates have risen so fast, it's making their investments in these bonds, worth less, which is, a hit to their balance sheet. So the rating agency added that asset risks are also rising for small and mid-sized banks, especially those with large corporate real estate holdings. Elevated CRE exposure are a key risk given sustained high interest rates, structural declines in office demand due to remote work, and a reduction in the availability of commercial real estate credit, it noted. Smaller banks are especially at risk given that they have sizable unrealized economic losses, probably in the millions and billions of dollars, that could cause investors to lose confidence, is stated in the Monday report. Guys, a lot of people, are starting to work remotely. They're not coming into the office. And what do you think is going to happen now that we have a new strain of this virus going around and potential lockdowns again? Like, this is going to hurt the banks even more. And some of these banks may even go bust. There isn't much call to be worried about the safety of deposits given the regulatory backstop such as the FDIC Insurance and the steps that U.S. regulators took when banks such as Silicon Valley Bank collapsed. Consumers were made whole, he noted. But guys, we know that the FDIC does not have the funds to cover everybody. We saw that in their secret meeting where they were talking about, having banks go bust on a Friday night. So these are the 10 banks that were downgraded. We have Commerce Bancshares, BOK Financial Corporation, M&T Bank Corporation, Old National Bancorp, Prosperity Bancshares, Amarillo National Bancorp, Webster Financial Corporation, Fulton Financial Corporation, Pinnacle Financial Partners, and Associated Bancorp. These are also 6 banks that Moody's placed under review for possible downgrades, with some of those banks amongst the nation's largest. They are Bank of New York Mellon Corporation, Northern Trust Corporation, State Street Corporation, Cullen Frost Bankers, Truist Financial Corporation, and U.S. Bancorp. Like, State Street is like one of the biggest banks out there, When you look at stocks and you see who owns the most shares, you see Vanguard, BlackRock, and State Street. Could you imagine what would happen if State Street went bust? That could cause a domino effect in the financial system. We also have 11 banks with negative outlooks. So the credit rating agency Moody's also said it shifted the outlook of 11 banks from stable to negative. They are PNC Financial Services Group, Capital One Financial Corporation, Citizens Financial Group, Fifth Third Bancorp, Huntington Bankshares, Regions Financial Corporation, Cadence Bank, F&B Corporation, Simmons First National Bank, Ally Financial, and Bank OZK. So yeah, you see Capital One in there. And right, a couple of days after I seen this article popped up on my phone from the Daily Huddle. It says the U.S. banks suffered $18.9 billion in losses as JP Morgan Chase and Capital One take big hits from bad loans. Report. Yeah, this came out August 18, 2023. So America's biggest banks are taking hits to their bottom line as soaring interest rates cause billions of dollars in loans to fall apart. JP Morgan Chase, Capital One, and others lost a combined $18.9 billion in the second quarter of this year due to soured loans, reports the Financial Times. The banks are facing charge-offs, or losses on loans, that have now been designated as unrecoverable at a 17% higher rate than the previous 3 months and a 75% higher rate than 2022. And you can see from this chart right here, loan losses by 10 big banks in the second quarter, right? Look at Capital One had the most losses at over $2.5 billion in charge-offs. You know, that's a lot of money. JP Morgan came in second. We also have Bank of America, Wells, Citi, US Bank, Truist, PNC, Morgan Stanley, and TD Bank. So in an earnings call last month, Capital One CEO Richard Fairbank said that the U.S. is coming out of an unprecedented credit environment that favored borrowers and that some type of consequence was inevitable. Yeah, we had, stimulus checks and free money and PPP loans going out everywhere. So it's like, it seemed like everybody had money at that time. But now that Jerome Powell is starting to raise interest rates, that money, that liquidity is drying up. And a lot of people are in trouble, a lot of people, lost their jobs during the pandemic and stuff like that. I just watched a video from Edward PhD, and it said that 51% of Americans, cannot pay their credit cards in full on a monthly basis. They're carrying that debt over, and it's accruing interest. And credit cards have some of the highest interest rates ever right now. Over 20% in interest. So, it's very hard for people to get out of debt once they get into it. The Capital One CEO says we have to remember that the credit performance we saw over the past 3 years was unprecedented. So we believe that there's some catching up that happens on the other side of that, especially for consumers who might otherwise have charged off over the past 3 years. Banks are now preparing for loan losses to continue rising and have already set aside $21.5 billion in contingency funds for future potential losses. But will it be enough though? That's the question. And so I seen that, Capital One has a negative outlook from Moody's. They suffered $2.8 billion in losses due to charge-offs. And I don't know if they have any commercial real estate within their portfolio, but if we go on lockdown again, they may take even more losses because a lot of these companies, are going to force their employees to stay home and work remotely. And, nobody's going to be in the office, and they may have to sell those office buildings, And with Jerome Powell raising interest rates, if they're still making payments on this commercial real estate, their payments would go up too, because they would have to refinance the mortgages and stuff like that. So the banks are in trouble, okay? I'm not trying to scare you. I'm just trying to let you know what's happening. And then, just a couple of days ago, the S&P also downgraded some big banks. So, S&P Global Ratings is downgrading the credit ratings of 5 banks, including some of the nation's largest lenders. The credit agency pointed to tough operating conditions that are straining the banking industry and also lowered its rating for 2 other banks. In explaining its rationale for the downgrades, S&P noted in a report on Monday that banks are facing risks that could make them less resilient than similarly rated peers. The move comes only 2 weeks after Moody's cut the credit ratings of 10 small and mid-sized banks because of growing financial risks and strains that could erode their profitability. Both credit rating agencies are taking the steps in the wake of a banking crisis that began in March when Silicon Valley Bank, once the country's 16th largest bank, collapsed just days after depositors grew fearful of its solvency and made a classic bank run. Underpinning the banking downgrades is a drastically changed lending environment compared with early 2022. Before the Federal Reserve began driving up interest rates to fight high inflation. Yeah, we were at 0% interest rates. People had stimmy checks out the wazoo. They had PPP loans like crazy. And now, they spent that money and they're in trouble. So, today's higher borrowing costs mean that banks must pay more interest to depositors while the value of some bond assets have slumped. Have you seen any rising in interest rates when it comes to saving accounts at your bank? Let me know in the comments, because I haven't really seen that. I've seen an increase on loans, but I haven't seen any increases on savings. The sharp rise in interest rates and quantitative tightening deployed since March 2022 to combat high inflation are weighing on many U.S. banks' funding, liquidity, and spread income, S&P said in its report. These factors have also caused the value of banks' assets to fall and raise the odds of asset quality deterioration. So here is the list of the 5 banks that the S&P downgraded, with a combined asset base of more than $400 billion. We have Associated Bank Corp, Comerica Inc., Key Corp, UMB Financial Corp, and Valley National Bank Corp. These are also 2 banks with a negative outlook from S&P, River City Bank and S&T Bank. And we also have 3 banks that are being reviewed by the S&P. Zions Bank Corporation, Synovus Financial, and Truist Financial. Now, why were these banks downgraded or reviewed? S&P said it reviewed these 10 banks because it believes they have potential risks in multiple areas. The rating firm added, for instance, some that have seen greater deterioration in funding as indicated by sharply higher costs or substantial dependence on wholesale funding and broker deposits. This may also have below peer profitability, high unrealized losses on their assets, or meaningful exposure to commercial real estate. Once again, the banks are in trouble, guys. Because, like I said, we're about to go through round 2 of this virus going around, lockdowns, working from home. Nobody's going to be using office space like that. And if nobody's using these office spaces and renting them out, the banks cannot earn a profit. They will have to be forced to sell these office buildings at a loss. So that's really bad, Liquidity is drying up. And it's going to get worse. Once all of these virus measures start going back into effect. Now they say, however, it added that the two banks it affirmed with stable outlooks, Synovus and Truist, had some factors that mitigated their risks. Should you be worried about your bank? Experts say that while the downgrades underscore the increased risks facing some lenders, most depositors have nothing to worry about. The ratings cut impact only a handful of more than 2,000 banks in the U.S. Regulatory backstops such as FDIC Insurance, as well as the steps that U.S. regulators took when banks such as Silicon Valley Bank collapsed, should reassure consumers. J.D. Durkin, the host for the financial site The Street, told CBS earlier this month, FDIC Insurance covers deposits of up to $250,000. But guys, we know that the FDIC has admitted that they don't have the money to cover everybody. It's really a game of musical chairs. And the Department of the Treasury decides who gets a chair. That's crazy. So, yeah. With all of that in mind, I'm a little worried about Capital One. I'm not going to lie. Capital One has been good to me. I have been using their credit card services for a couple of years now. I have the Quicksilver One card, and I also have the Saver One card. And in the future, I want to get the Venture One card so I can start earning travel points, as I spend. And then I can travel for free. Travel points for the win, right? But all this news coming out has me thinking, what would happen if Capital One, was to get downgraded? Would they have to start cutting back on their credit? I was in high school when the 2008 financial crisis happened, right? But I was listening to Edward PhD, and he said, he lived through the 2008 financial crisis, and he said when the banks got in trouble, they started tightening their lending practices. People couldn't get loans like that. People who had credit cards had their credit limits, cut in half. And, I use my credit cards to, pay my rent in advance. And then when I get paid at the first of the month, I pay them off. And that also helps build my credit. But, man, what would happen if my credit card limits were cut in half? That could put a serious strain on me, What would happen if Capital One would go bust? Would my credit cards just stop working? That would be bad. That would be really bad. I'm not saying that this is going to happen. I'm just thinking about all this information that's coming out, and I want to hear from you guys what you guys think. Luckily, I have my digital assets to fall back on. So, if I ever needed a loan, I could take out a decentralized loan. But man, if the banks were to go bust and your credit cards would stop working, man, that would be a serious credit crunch right there. But yeah, the banks are in serious strain right now, and it's only going to get worse as lockdowns come back for the second time. So you need to, start diversifying yourself. I need to start diversifying my credit cards. Diversify your assets. And also you need to get your credit up, because if there's a credit crunch, these banks are only going to want to lend, to people with really good credit. I was listening to John Williams, and he said that, when the financial crisis happened, A lot of people weren't able to get loans, man. He's saying that, 650 to 690, that's not going to cut it anymore. You're going to need 720, 750 or higher. So, yeah, man, that's what I wanted to talk about in this video. Let me know what you think. Did you see any of the banks that you bank with on these lists? Do you bank with Capital One? Do you have any credit cards with Capital One? I want to hear from you. Let me know what you think. Alright, this is RPU, and I'll see you in the next video. Peace.
It's really important. I mean, it's a little bit conflicted, right? I mean, it's important that people understand they can be bailed in, but you don't want a huge run on the institution. But they're going to be.
People need to know, but I don't think you have much hope of reaching a public that doesn't have a professional need to know.
I completely agree with that. I almost think you'd scare the public if you put this out. Like, why are they telling me this? Should I be concerned about my bank? Like, my insurance company doesn't tell me what they're doing with my assets. If they just assume they're going to pay my claim. Right? I think you've got to think of the unintended consequences of taking a public that has more full faith and confidence in the banking system than maybe people in this room do. So there's a select crowd of people that are in the institutional side. And if they want to understand this, they're going to find a way to understand this. There's a bunch of law firms represented in this room. There's a bunch of people that charge them by the hour a lot of money to explain this all to them. And it's fine. I don't have a problem with that. And they all have huge staffs. But I would be careful about the unintended consequences of starting to blast too much of this out in the general public.